Hello everyone, welcome to part 2 of our discussion related to the exclusion provisions for gross income. So everything in this video, the way these exclusions are grouped, all of these were paired together because these exclusions try to mitigate They try to mitigate double taxation. So they don't want to try to tax the taxpayers too much. So the first example of this type of provision is the exclusion for gifts and inheritances. So when someone dies, if they have assets, those assets are usually liquidated and then distributed out to whoever is designated to receive them. Sorry, I was trying to think of what I wanted to say. So in that would be considered an inheritance. You're inheriting something of value from someone that passed away. And so while that could be hopefully something of a lot of value to you, depending on what kind of assets the person had, gifts and inheritances are excluded from the gross income of the individual that received that gift or inheritance because those transfers are already subject to a federal gift and estate tax. So since they're already being taxed once, they don't want to tax the individual recipients a second time. Another type of income that we will discuss here is life insurance proceeds. So life insurance proceeds, what those are, is they are amounts that a taxpayer can receive due to the death of the person that was insured. And those amounts are excluded from the person receiving those proceeds. Those are excluded from their income. And the reason why life insurance proceeds are excluded from income is because they are typically subject to that same federal estate tax like an inheritance would be. However, because it's always good to have caveats, right? However, if the proceeds are paid over a period of time rather than in a lump sum, a portion of those payments actually represents interest, and then that must be included in gross income. So that is our caveat to the general exclusion. Other things to consider for life insurance proceeds. The exclusion also generally does not apply when a life insurance policy is transferred to another party for valuable consideration, or the taxpayer cancels the life insurance contract and receives proceeds in excess of the premiums paid. So for that first part, what is valuable consideration? So under valuable consideration cases, the life insurance proceeds collected by the purchaser are excluded up to the sum of the purchase price of the policy and any subsequent premiums. And so then remaining proceeds after that are considered ordinary income. In addition to that, exclusions are available for accelerated death benefits. So that's a good term to know. Accelerated death benefits in certain circumstances. And the meaning of accelerated death benefits is if the taxpayer is terminally ill. So I'll write down that. Terminally ill, meaning that they are medically certified with an illness expected to cause death within 24 months. So I guess another way to explain that, if the taxpayer is terminally ill, that early receipt of the life insurance proceeds are not taxable in this instance. Another term that is helpful under the accelerated death benefits piece is chronically ill. So if someone is chronically ill, I'm gonna make this look more like a C. So if someone is chronically ill, that means that the taxpayer has been medically certified to require a significant amount of assistance for daily living activities, or they have something that has a lot of cognitive impairment. So then whenever that happens, if they are receiving life insurance proceeds, as long as those proceeds are paying for the taxpayer's long-term care, then they are not taxable. The last exclusion type that falls within the category and theme of this video is exclusions for foreign earned income. So I want to stress that this is for income earned outside of the United States. So that means you worked some sort of job or provided some sort of service somewhere outside of the United States. And so the reason why we have these foreign earned income exclusion provisions is because whichever country you are working in, it is very likely that you are probably paying tax in that country as well. So let's put a country name in there just to kind of stick with an example going throughout. So let's say if someone was working in Germany, for example, because there's a few big corporations that have headquarters in Germany, like Bayer or Anheuser-Busch InBev, so we'll just use Germany. If someone was working in Germany, it is very possible that they are paying taxes to Germany, but then they would also be subject to taxation in the United States if they're a United States citizen working over in Germany. So to prevent that double taxation, there is this foreign earned income exclusion. And so what the exclusion is, or I guess the main one, you can exclude from your gross income, if you qualify, you can exclude up to $130,000 of foreign earned income. If you did not want to take this exclusion, what you could do instead, so you have a couple of options. Instead, you could deduct any foreign taxes paid as an itemized deduction, or you can claim the foreign tax credit for foreign taxes paid on your foreign income. So I feel like since you have a couple of options, I feel like it would be whichever option would help the taxpayer maximize their after-tax wealth, because that's the whole point of tax planning, just to give a little connection back to chapter 3. Also under foreign earned income exclusion provisions, you can also exclude up to $18,200 of employer-provided foreign housing, but only to the extent that the costs exceed $20,800. And so all three of those numbers that we've mentioned so far are all indexed. So then when we get to 2026, those numbers are going to be slightly different. A small stipulation for the foreign earned income. In order to be eligible for the foreign earned income and housing exclusions, the taxpayer must have their tax home in a foreign country and 1, be considered a resident of the foreign country by living in the country for the entire year, a calendar year, or option 2, they live in the foreign country for 330 days in a consecutive 12-month period. So we're going to wrap up this video set with an example problem to look at these stipulations for the foreign earned income exclusion. Alrighty, so let's look at our example problem. Courtney is considering a transfer to EWD's overseas affiliate, where she will be paid $140,000 annually. Assume that her 12-month qualifying period includes only 200 days in the first year and 140 days in the second year. How much of her expected $77,000 salary in the first year can Courtney exclude? All right, so another detail that we need that the problem didn't mention, we are going to assume a 365-day year. So assume 365-day year. Alrighty, so our question wants to know how much of her expected salary in the first year can be excluded. So I'm going to highlight that first year because that is an important piece of information. So, some information we will need from the problem. It tells us that assume that her 12-month qualifying period includes only 200 days in the first year. So she wouldn't be able to take an exclusion for the entire year, only 200 days. So then to calculate how much she can exclude, if we think back to the previous slide, our maximum income exclusion amount is $140,000. $130,000 for 2025. Then we will want to multiply that by the percentage of the time she was in the country for the year. So we know that Courtney, was in this country for 200 days of the 365 days in that year. So then, whenever we divide 200 by 365 to get our percentage, and then we multiply that by 130,000, the amount that she is allowed to exclude becomes $71,233. All right, guys, this concludes this video. We have one more to get through. I appreciate you sticking with me. And we will be wrapping up our discussion of exclusions. See you soon.